In this video, traders, we're going to look at 4 key fundamentals to watch in FX, the biggest 4. Stay tuned. Hey guys, everyone, welcome to you. Okay, so 4 of the biggest fundamentals you should be watching if you're trading Forex. Doesn't mean you have to be an economist, doesn't mean you have to study these things exclusively, but you should have an idea on how these affect the currency pair that you're trading. Right, number 1 is interest rates. Interest rates is the biggest one, I think. Higher rates generally attracts foreign investors. So the interest rate, obviously, of the country that you're trading, US, or the US interest rates, whatever the central bank has set the interest rate at, ECB for euro, Bank of Japan for yen, etc. That interest rate, generally speaking, these are all kind of broad theses. Sometimes things change slightly and adjust, but the higher the interest rate, the more valuable the currency, because it will attract foreign investors. If they see they're getting 10% on the interest rate, they might start to pile their money into that as they start to then use that as a way to put the money, receive 10% on that, borrow another thing. That's the carry trade. I won't go into that here. I've done a video on that before. Borrowing at 1%, loaning it out at 10%. Great, you're all making money as long as that country is stable. So when you get the bigger economies raising interest rates, that can appreciate their currency. So look out for that in the currency pair that you're trading. And also don't forget, right, and some people forget this, is the expected interest rate cycle that the current immediate valuation of the currency is. Very rarely do we get surprise rates. We do from time to time, and that's when you get massive moves in currency, suddenly surprised by hiking by half a percentage point. Money just flows in because all of a sudden it's repriced the value of that asset. When we have, this is where we come into other things here, but other things will give economists and the city and the street an idea of where interest rates might start to increase, and then they allow for that. So you might get appreciation. The currency saying, well, actually, I think they're going to bring forward the rate into the quarter, into Q4 rather than into Q1 of the next year. You get the idea. And so that might adjust the revaluation, but ultimately it's all down to when interest rates are going to rise or when they're going to be cut. Second one, employment. Generally speaking, again, we're generalizing with these things, higher employment equals higher spending. So goes without saying, really, if you haven't got a job, you're probably not going to spend. If you've got a job, you're going to go out and you're going to spend. You're going to spend on goods, you're going to spend on durable goods, you're going to spend on bigger ticket items, you're just going to spend. More money is going to flow around the economy, right? It's common sense. But also, higher spending also tends to lead to higher inflation. Higher inflation also tends to lead to a rate rise. Inflation is running away with themselves. One way that central banks can stem that inflation is to increase the interest rates, encourage people to save rather than spend. Don't spend so much in the economy. Don't get the inflation running away with itself. So if we have higher spending, people think that rates might rise a little bit sooner. These kind of numbers that come out, higher employment numbers, might then be extrapolated out to saying, well, interest rates are going to rise a bit sooner than we thought. This currency now becomes more valuable. We can see how it's all interlinked. And again, like I say, really generalizing here, but this is what we need to know. And the key to trading these things, guys, is to know the general feeling and theme around it, but to also know the current feel, and you can get that from the traditional financial media. I don't normally say use them for anything, but you can see how traders are feeling, because often they might be saying, well, we're going further than that. We're saying, well, actually, we don't think it's going to raise rates because this and this, and there might be some other catalyst or input that is negatively affecting it. So often you get the opposite effect, but generally this is what happens. And there are some times when it doesn't happen, but you can lose the financial media to dictate, hey, well, actually that's considered as bullish in this example because of this and this, or it's bearish at this moment in time because of this and this. You get the idea, and then you can position yourself accordingly. Number 3, economic growth. Consumer spending, house price growth, normal things, looking at those things, house prices start to go up, the economy just is improving, right? House prices improving, consumer spending's increasing, all this kind of stuff is just all interlinked. Eventually could lead to higher interest rates to stem inflation, also the power of the country's buying power and how profitable generally the country is, the GDP. All right, number 4, commodity prices. So if you're trading commodity currency, you're going to look and say, okay, the net importers or exporters are going to be affected by the value of that currency, by the value of that commodity. So, for example, let's say Canada, Canadian dollar, they're exporters of petroleum products. And so And another example would be AUD. Australia exports copper, gold, etc., natural resources. And so generally speaking, higher prices for the products that are being produced and exported is good for the producer. Obviously, if you're mining out a chunk of gold, if that's worth more, then you're going to receive more for the same amount of work you've put in, right? That's very simplifying things, but you get it. If you're extracting and refining crude oil, for example, and you're suddenly getting more for that piece of work and all those stuff that goes into producing that than you were before, you're going to be richer for it. So generally speaking, that's going to offset, that's going to show itself in the value of your currency. As the commodity prices are rising, then the people who are producing those commodities are going to benefit. The people who are consuming those commodities are not going to benefit. So if you've got really high prices for a specific commodity that a country imports a lot of, for obvious reasons, they're having to pay more for the same amount of goods coming in, for whether they're using it for whether they're using it for manufacturing or whatever. All of a sudden that leaves them in a poorer state as a whole, so that country's currency may well be devalued. Okay, so I've simplified stuff here a bit, and I've said that before, we're simplifying things, but at least now we've got an idea, guys, 4 key fundamentals to watch in FX, having a broad understanding of what's affecting the currency market. And like I say, the tip is to look into the financial media and the time you're trading it, just to see exactly what the driver is, because merely often people don't care. Interest rates may be flatlining for years, and so that's not a big thing. They might be looking for the next this, the next that. And so having your fingers on the pulse as to what is moving the market, what's the market's engine, so to speak, is a key thing, as well as having to this kind of basic info of the 4 fundamentals that are moving the currency you're trading. All right, guys, take care. Keep your risk managed. Whatever you do, see you next one. Bye-bye.